Good morning, everyone. Welcome to the ATA Regional Business Summit 2025. This is not your usual conference with boring PowerPoints. Today is about big ideas, bold entrepreneurs, and brilliant conversations. On behalf of American Telugu Association, I'm thrilled to have you all here, entrepreneurs, professionals, business owners, and investors. Basically, the movers and shakers that can make things happen. Before we dive in, let's take a moment to recognize the powerhouse behind this summit. American Telugu Association, or ATA as we fondly call it. For over 30 years, ATA has been connecting professionals across North America through culture, education, and community service. It is one of the largest and oldest organizations of its kind. Through business summits like this, ATA is helping turn connections into collaborations and dreams into deals. Let's give a big round of applause to ATA for making this platform possible. Before we get started with the event today, I would like to extend a special thanks to Henry Eckelberg, Loudoun County Treasurer, for his continued and invaluable support throughout.
Thanks for paying your taxes.
That is all that matters. So, now I would like to take this opportunity to welcome ATA Chair, Business Chair Harish Batni onto the dais to get started and kickstart the event.
Thank you. Good morning, everyone. I hope it's a holiday for Virginia and Maryland. I hope everyone is a little more free than before, but hopefully we take as much rest before the government starts back. Welcome, everyone, and my name is Harish Batni. Thank you all for joining this morning and making it a great one. And welcome you on behalf of American Telugu Association. American Telugu Association is generally it's known for its cultural activity, but we got in a new innovation where we are trying to do more of business committee and business section, where we help. The motto of American Telugu Association Business Summit is to get more of Indian American professionals into entrepreneurs. We want to network all the Indian Americans and then grow them and bring under all umbrella and give back to the society. And we want to build in an ecosystem where all the diaspora is in one umbrella and the community grows and gives back to society. Saying so, I would like to invite our main pillars who has helped in this event to come to this stage. I would request Mr. Naveen Ranga, please come onto the stage. I request all the RCs, Mr. Venkat Doma, Srikanth, Raj, every one of you please come onto the dais, please. And please give them a big applause. Ravi Chella, I request Ravi Chella also to please join us. Dev Wontla. These are the people who've been working from last 2 months to make everything successful. I thank every one of you for being a speaker or sponsor and being over here today. And I would request our president, Mr. Jay Chella, to please come on to the dais. He's been working like a 20-year-old kid, energetical guy, and he's been doing so great things from the last 9 months. I would say, please give me a big applause to him, please. I would request him to talk 2 words, please.
Yeah, Vishnu, BOT, please come on. It's thank you. We've been. Good morning, everyone. Thank you all for coming here on Saturday morning. I really appreciate you doing this. So, like Harish said, American Telugu Association is a 35-year-old organization. We've been serving the community in the U.S. In cultural, literary, business, and other aspects. So this time, we're trying to do something innovative, which is having regional business summits throughout the country and not just focused on IT alone, information technology. Typically, there's a perception that Indians are more into IT and that's what they do. And lately we have been diversifying into multiple other areas. So with the hope of creating more entrepreneurs and diversified business areas, we have taken this. We have done it in Atlanta, we have done it in Phoenix, we are doing in Nashville and here. So hopefully we'll get good traction as we move on. So without, I think further ado, I apologize for the delay. In starting this program, we tried to do it at 10, but I think we're a few minutes late. So nevertheless, let's get started. Thank you all.
Thank you, Jay.
Thank you, Atta, for everything that you do. So, before we get started, a brief agenda of what we have planned for you today. Today, we are diving into some truly exciting areas. To begin with, the real estate, because who doesn't love an appreciating asset? And next, following, we have education and women entrepreneurship, because empowerment is the best investment. Next to that, we have hospitality and retail, the world of flavor, comfort, and customer magic. And finally, artificial intelligence, because if you're not already thinking about AI, trust me, AI is already thinking about you. So buckle up, because it's the day of inspiration, networking, and some aha moments. So let's get started. Let's start with the topic that everyone secretly checks on Zillow during your breaks, the real estate. Whether it's land, commercial, or residential, real estate continues to be the heartbeat of wealth creation in our community. Our moderator for this powerhouse panel is Mr. Greg Derby, the principal at Story Street Advisors, a true real estate guru. A man who knows more about deals, developments, and square footage than what we do about scrolling through our phones. So let's put our hands together and welcome the first moderator of the first session today, Greg Derby, onto the stage.
So before we get started and these guys introduce themselves, just for our benefit, we were curious how many folks here invest or participate in the real estate industry, and how many people are more focused on IT? If you can raise your hands and just let us know. Real estate. So a lot. Okay, there we go. More than half the people. So Suraj, why don't you go first and introduce yourself?
Yep. Hey all, morning. My name is Suraj. I am the managing partner of an investment firm out of Austin, Texas called East Avenue Investments. First, would really like to thank all the folks that have put the event together. This is great. It's really nice being up here. So in terms of our firm, we are diversified, but in the last year we've really focused on land. So in Texas, you got land. So just looking across the sky, right? So it's a big investment, buying land and trying to go build it into homes. And in the past year, we've also focused on a fixed income strategy just based on some of the macro concepts called land banking, which I'll talk a little bit more about. But it's great to be here.
Good morning, everybody. My name is Deepak Hathiramani, and I'm with Steel Harbor Capital Partners. I would like to thank Atta very much for this opportunity, and specifically Jay Chala, Harish, and Naveen for giving us this opportunity. Just a brief background about myself. I worked in tech for about 30 years, and after that decided to follow my second passion, which was real estate, and went back to school full-time and in real estate, and then found a partner who was smarter than me, and we launched Steel Harbor about 7 years ago. We are basically a real estate investment firm that's focused on multifamily development based on the migration of population from highly dense markets to the secondary markets in the mid-Atlantic and the southeast, I should say. We run a GP structure, which is very different from an LP structure, and I think we'll get into that in the discussion. And We are focused on ground-up development, significant value add, and we create paper around pref and mezz instruments in the real estate space. Thank you again for having me. And I see a number of our investors are here, so their investments has helped us get to where we are today. So we are very grateful for that.
Thank you. My name is Stephen Carbelk. I'm one of the founding partners at DSP Real Estate Capital, and we purchase and manage and hold multifamily properties. We currently have about 1,600 units in Virginia, West Virginia, and South Carolina. We're based in Ashburn, Virginia, and I've been in real estate since college, 34 years ago. It's been a long time. It's all I've ever done, and I'm just absolutely passionate about multifamily, and looking forward to our conversation today.
Okay, this is on. All right. Just to give a little bit more background on myself, I focus on real estate consulting, strategic consulting, and capital markets advisory. So I raise equity, LP, GP equity, structured finance for real estate projects, all property types, all markets across the country. Before we dive into some questions with the panel, more for the benefit of the non-real estate folks, we thought it would make some sense to kind of define the risk spectrum of real estate investing. Just like investing in a stock market, there's different ways to invest, whether it's a focus on cash flow or a focus on appreciation or a combination of the two of those. So we'll do this real quick and then we'll get into some panel discussion. So the least risky type of investing in commercial real estate is defined as core investing. And that's effectively synonymous with income investing in the stock market. So if you want to think of what a core investment is, you just think of it's going to generate a lot of cash flow. You're not going to put a lot of leverage on it. So the maximum leverage you're probably going to put on is 50% of cost, or LTC. And the return profile is going to be 7 to 10% returns. And it's going to be consistent cash flow. So maybe one way to think about that is like a long-term leased CVS as a core type investment, very low risk. The second is Core Plus, which is synonymous with growth and income in the stock market. And that's a low to moderate risk profile. So high quality properties that present an opportunity to increase cash flow through light property improvements, operational efficiencies, or by increasing the tenant quality to stronger credit tenants. So think of like a newer vintage apartment building that you might be buying, or a grocery anchored shopping center. And these returns are 8 to 11%, and Core Plus investment will have leverage of maybe 50 to 60% loan to cost. The next is value add, which we'll get into a lot more with the panel. But so that's synonymous with growth in the stock market, and it's moderate to high risk. So value add properties typically have lower cash flow when they're acquired, but have the potential to produce a lot more cash flow once value has been added. Properties can require significant physical improvements, so renovations. They may have low occupancy or poor existing management that provide opportunities through skilled ownership to increase the property performance. We're talking about returns in the 11 to 15% range and leverage of 60 to 70% sort of typical. And then the last and the riskiest is opportunistic. And that's any type of new construction, land acquisition, development, repositioning of a property from one use to another, so like a conversion of an office building to apartments. Typically no cash flow, and it could take 2 to 3 years to see any return on investment. Executing on opportunistic strategies requires a lot of skill and expertise, a team of people to execute on it. And it's typically looking at 20% returns and leverage of 60 to 75% on that type. So with that, I thought it made sense for the panel, now that you all kind of understand the risk spectrum, to talk about where in their business they participate on the risk spectrum. They give a little bit of highlights on what their businesses do, but this could give a little more definition on that. So Suraj, if you want to start.
Yep. Thank you for that. So it's really interesting. In our business, we kind of focus on both of the extremes. So on one side, we have a land banking strategy, which is what we've been doing for the past year. where this delivers a 12% annualized return paid out every month. So we have a structured option contract. We have a counterparty that knows what they want to do. So I view that as the least riskiest kind of the comp to a high yield savings account or a private credit, which I know is, or rescue capital, which I know are hot sort of new spaces coming in here. And on the very other side of the spectrum, we purchase raw land, right? So this is land that has no infrastructure, that has no entitlements. And for us, these are, we're working anywhere from 2 to 3 years with our civil engineers, our planning architects to go create master plan communities, especially in Texas, but all across the country, right? Master plan communities are big business, but it takes a lot of work and a lot of effort to go get that up and running. So I would say, on our fixed income side, a lot more core. That's part of why we've been doing a lot of it recently. But previously, historically, it's been a lot of land acquisitions and land entitlements and development.
Before going to Deepak, just for the benefit of the audience and folks not familiar, can you describe what it means to get entitlements? What is that process?
Yeah, absolutely. So I think when people say they're not making any more of land, right? Invest in that. I think that there needs to be a caveat to that. They're not making any more developable land, right? And developable land is very different than raw land in that you need a permission, right, from the government, whether it's the county, it's the cities, utility providers. You need to go through their process to get your project engineered and approved in order to go get it ready to build. And that process can take a lot of time depending on where you are. So I know California is pretty notorious for taking a really long time. Same thing in certain areas in Texas and Austin because of things like, folks don't want as much traffic, right? Or you've got utility issues. I mean, there's a ton of different constraints to it. So I would say the entitlement process is taking a piece of dirt and turning it into something that can actually be developed.
And is it just a political or an administrative or a combination?
I would say it's political, administrative, and it's based on different jurisdictions, engineering, right? So in Texas, the big question right now is water. For us, we have tons and tons of growth, and you're looking at strains from everything from infrastructure to water, and now with AI, with the data center boom kind of coming in, you have a lot of constraints around power and other utilities. So I would say it's kind of a mixture of everything. Definitely political doesn't help. Usually we try to buy in jurisdictions where the politics are more favorable to growth. But kind of what we've seen is around the country, counties and cities, they like growth until they get it. And then after they get it, they don't want it anymore. So it's kind of like, trying to keep ahead of those curves.
Okay. So I know you're from Texas, so we talk about difficult entitlements. Arlington County, Montgomery County, Fairfax County. Believe me, Jay knows. So Deepak, if you want to go.
Sure, thank you so much. We are focused mainly on long-term wealth creation and protection of capital, but mainly on after-tax returns. We are what we consider an opportunistic fund, so we are high-risk, high-gain octane fund, basically, on what we do. And what we try and do is create value both at the bricks and sticks level, which is the actual real estate, but also at the structuring level. To his point, real estate is very local, and understanding the local jurisdictions is very, very critical in any investment that you make or consider. And there are lots of lessons learned from that we will talk about in the thing. The one thing I do want to point out, which is going back to the comment I made earlier, investing in real estate as a limited partner versus investing as a general partner is very different. As a general partner, you are always promoting off a limited partner, and so your returns tend to be higher than the deal level, net of expenses, net of fund fees, and net of promote. You tend to be in a much better position as a GP than an LP.
Is it worth just spending a second to describe what promote means, in case people don't know?
Sure. The promote is the amount in any deal. If you take an example of a $100 million deal, you have about 60% debt, which is $60 million, and then you have $40 million in equity. That $40 million is generally split 90-10, where 10% comes from the GP and 90% comes from an LP like JP Morgan, Goldman Sachs, etc. if the deal level return is a 15 IRR, there is a waterfall structure that says, first everybody gets a return of capital, then you get a return on the capital, let's say it's 8%. Everything above 8% is split between the LP and the GP, where the GP takes a proportionate share of the LP's return. So it's very beneficial and accretive to being in the GP position.
And just so you understand, that is the reward to the GP for their expertise in executing the business plan on a property and creating the value and generating return. Stephen, you want to go?
Yes, so DSP, we have been focused on buying high-quality properties in secondary markets where we like just steady growth. We avoid markets that have high headline risk, like Miami. It's up one month and it's way down the next month. We don't want to be in those type of markets, so we're invested in Richmond, Columbia, South Carolina, Roanoke, Virginia, Martinsburg, West Virginia, and out also in the Winchester area. And we've also been buying brand new build-to-rent communities from a national home builder, where we'll buy the entire subdivision and lease it up. And our model is really focused around paying our investors 6% preferred return every annually, distributed quarterly, plus 80% of the upside. So when you're looking at the risk spectrum, it's kind of that slow and steady growth by buying high quality assets that are producing solid cash flow. As opposed to having CVS pay you or not, I'd rather have 250 people, or in our case 1,600 people paying us rent, as opposed to one or two tenants, and it just spreads out the risk. So that is really been our philosophy. As it relates to being a GP, yes, you can make more money, but it's very much, you're running a business. I mean, we have staff and office lease, and it's a significant amount of capital because we are responsible for the investor's money and to make those returns. And so it is a significant amount of work in order to be able to execute on the business plan. Keeping in mind, in the business that we're all in, we're not just buying real estate, holding it, and then flipping it in 5 years. We're actually buying businesses and running businesses. And the real estate is almost secondary to the actual investment, because the real estate is just simply the way in which we're generating that cash flow. So that's what we've been doing. I will say, when we first got started, it was a heavy value add deal that we did because that's all we could buy, and that's all the brokers and sellers would sell to us. And then as you start proving yourself within the market, then you're able to get access to higher and higher quality deals. And so now, we have a relationship with the largest home builder in the country to be able to buy, build-to-rent communities. So it takes a long time to get there. I don't know how long my fellow panelists have been in business, but we just celebrated our 5-year anniversary, which we're really excited about, and looking forward to our 50th. So, thank you.
Thanks. Let's touch on sort of the macro and micro market. So to start, I'll kind of go first from my perspective as an intermediary in the capital markets and raising equity. The last 2 years, and especially this year, have been incredibly challenging in the commercial real estate industry to raise institutional capital, whether it's for a fund or for individual property investments. Capital is very selective. With that said, there are a few sectors that are quite popular right now, one of which is data centers, which everybody seems to know of, and since Loudoun County is represented here, it's a pretty big topic there. Senior housing has also become quite popular with institutional capital. And then, as Stephen was mentioning, the built-to-rent space is still a space that's seeing a lot of growth. Now, this is focused primarily in growth markets in the Sun Belt, whether it's the Southeast to the Southwest. With that, love to get the perspective of our panelists as to what they are seeing from a macro perspective, and then what is driving their investment thesis at a more micro level in specific markets. So, Suraj, we'll start with you.
Yep. Yes, I mean, I think real estate, even more than other asset classes, is very interest rate dependent, right? So obviously during the COVID years, you had rates sort of drop to a rock, to zero, and you had a lot of capital flood in. When you're able to go finance things for 2%, 2.5%, that's kind of where you had tons and tons of money flow in and sort of build up valuations, right? And then historically, we've had, in the past 2 to 3 years, one of the largest rate hike regimes, like pretty aggressive rate hikes, right? And now you got to the point where people bought things at high valuations, and then, they're trying to go pay their debt, and suddenly their debt service, which is on a floating rate, which means, it's tied to either a treasury or the way the SOFR rate, which is what the Fed, charges for banks, it suddenly shoots up, right? And that puts a skew in the business plan. So, I would say that's sort of some of the context for why there's some challenges right now in the market. I would say definitely, when I'm looking at it, between what sellers and what buyers, pretty much in most asset classes are looking at, there's just a massive spread between it, which is why there hasn't been as much transaction volume. But that being said, right, I mean, I think for us, we invest in a lot of the Sun Belt. Like, I invest in Austin. We do a lot of work in Utah, Arizona, Colorado, Florida. And those sort of markets got bid up pretty heavily. But I think the flip side of that is from the long-term growth projections, you're still seeing people move there. You're still seeing jobs move there. You're seeing income growth there. And so from our standpoint, the way that I look at it is in these past couple of years, it's giving us the opportunity to sort of not compete and bid against projects, but be very selective in what we buy, build our relationships with folks. Like, we do a lot of work with home builders. And these home builders, now that they're slower, right, we can act as solution providers for them and get more favorable terms. And then also sort of betting on the long-term macro, which is really, I think, in the Sun Belt, lower regulation, more people move in there, more jobs move in there. You buy the high-quality assets. Once the interest rates kind of flip a little bit, right, go decrease, it just gives you a lot more value in the deal. But from our standpoint, we don't look at interest rates as the primary driver. We kind of look at really the macro demographics, right? Income, population, sort of family formation, infrastructure, those sort of things. That's really what drives our theses.
One thing you touched on, which I think is interesting, just for members of the audience who consider real estate investments as limited partners, is understanding what the business plan is with debt. Because you touched on something that has had a huge impact in the real estate space since basically COVID with the floating rate debt. Mm-hmm. And if you don't understand the risk that you're taking with floating rate debt, you shouldn't make the investment.
Yeah, and one thing to point to with the GPLP, I think with the GP, another sort of role that they play is being able to provide the debt to the deal, right? So they're the ones that go to the banks or the institutions, and then they give guarantees. So that's where I think, in a lot of today's environment, they look at your personal balance sheet and say, how much cash are you generating? Can you pay this debt off if we foreclose this and we sell it off, right? So I would say that's another thing that the GP takes the risk off the LPs, where they tell the bank, they say, hey, I will personally guarantee that I will, pay off this asset, and essentially you're collateralizing as the GP all your other assets, whereas the LP is protected from that.
Deepak, do you want to take this question?
Yes. So the first thing I would like to say is that real estate tends to be very lowly correlated to stocks and bonds. Different asset class, different risk level, different tolerances, and different returns. So comparing the stock market returns to real estate is not an apples to apples comparison. The last few years, there have been some macroeconomic factors that have impacted the sector, both negatively and positively. I'll start with the point that Suraj made. First is interest rates is a big driver. And the run-up in interest rates affected leverage, affected valuations, affected cap rates, all of which impacts returns. The number of other factors that we think impacted real estate negatively are insurance costs went up, labor costs went up. There's been an oversupply in the markets, in certain markets, based on where you are. And you have to take all those factors into consideration when you look at your investment in real estate. Affordability is another big one. When you're spending 30% of AMI, what's known as average median income, on shelter, that market is considered, there's an affordability crisis. So there are some factors that have affected the real estate market. But there are also some tailwinds. The tailwinds are, we think interest rates start coming down, which they've started. That will impact valuations, that will impact returns on the funds, one. Two, we think that the regulatory environment is going to get easier. Two, both at the federal level and hopefully at the local level. And three, the oversupply that is in those markets is getting absorbed. If you look at construction starts, if you look at permitting starts, they're all way down. And what that implies is 2 years from now, there's going to be a shortage in the market. So those are some of the factors to consider when you look at investing in which markets. Besides the fact that what is the inbound migration, what are the major employers moving into the area, and the local dynamics of the county and the politics of the county.
Yeah, so to add on to that, and those are all excellent points, is it's just really important to understand your own personal investment thesis as to why would you invest with a particular company and what they're buying. In our case, our investment thesis is focused on the idea that the younger generation, they're not buying homes. They can't afford homes because of student debt. They like to be more mobile, and so they're more likely to rent. And if you believe that, and you believe that's going to last another 5, 10 years or longer, then you would invest in multifamily. If you did not believe that, if you thought the next generation was having more kids and could buy houses, then maybe you would invest more in land or what have you. It really depends on what you think. And of course, that's going to be location driven as well. But for us, we firmly believe that even on like the build to rent communities that we're buying, that there are younger families that want to live in a high quality space, like a 3-level or 2-level townhome, and not an apartment, but they just want to rent, or they can only afford to rent. So it meets that specific need. The other important, as he was talking about on returns, important consideration is that when you invest as a limited partner, you also get a K-1 every year. And under the big beautiful bill, there was they added that you're able to get bonus depreciation up to 100% based on a cost segregation study, and we could have a whole conversation on this. But basically, it allows you to be able to get a pretty significant negative K-1 year one, that if you have qualifying passive income or you're a real estate professional, it helps offset income today. And the idea is that you can just defer your gains until later in life. And based on your age, it may be good that by the time you retire and you have a low income, but you have high cash but low income, when you go to realize that capital gain, perhaps it'll be at a lower rate. So those are all considerations that you should have.
I would like to add another fundamental point. If you look at there is a significant supply-demand imbalance in our country. Mm-hmm. We are approximately 3.5 million homes short. And that is a significant imbalance, which is going to take years to catch up at the current build rate. So the demand is definitely there. What has hurt the market is the interest rates, which has impacted all the factors that I described prior to that. The other thing that's on the flip side of that, to the point that Suraj made, fund managers or investors whose whole model was based on close to zero interest rates, floating rate, have gone through a lot of pain. Because when that debt comes due, they cannot get it refinanced. They either to return the property to the bank, or they go to the investors to raise more capital. And there are a number of funds that 5 years ago did great, but are in a lot of pain right now. And that has created an opportunity to acquire some of those assets at very good valuations. The other opportunity that's been created is banks have pulled back leverage from 70% down to 50, 55%. So owners now have a shortfall in the capital stack, and there's an opportunity to create pref instruments at very good returns on the risk that you're taking.
A couple points I just want to add to what you guys were saying, and then I'm going to give you a surprise question that we didn't talk about before. But what Deepak was just talking about with floating rate debt that was on, especially in the multifamily space, what you haven't seen, yes, on paper there's a lot of pain, but what has not happened yet in the market is a lot of transactions for that. So everyone came into 2025 thinking this was going to be the year we were going to finally see banks stop extending and pretending on us, which is what's happened, and actually deal with these problems. But it hasn't happened, so transaction volume has been very low. I think part of that is because of interest rates and other uncertainty just generally in the economy. But from my perspective, in the work that I do, I've been waiting for that domino to fall. I've been waiting for things to start trading, for banks to take action on this so that we can start generating some transactions in the marketplace. The other question, the question I have for you guys, because you've all touched on how important interest rates are, is what do you think the impact on long-term rates is going to be? So obviously, when the Fed lowers rates, that's the overnight rate, basically. So it impacts short-term rates, which works for floating rate debt or short-term debt. But it doesn't if you're looking at long-term 30-year financing or something on a property. What do you think the impact on interest rates are on the longer interest rates?
Yeah, no, I mean, I think that's a really, really good question, right? Especially with everything that's kind of happening in the new regime, right, with tariffs, the one big beautiful bill, deficits, de-dollarization. There's a lot of stuff kind of being thrown out, terms. So I would say my personal view in the long term is that rates are going to be higher than they are in the short term. So they have this concept in finance, right, called the curve, the yield curve, where the concept is, the shorter you are, the less risk you take, so the lower your rates are. And then on the flip side, the longer you buy, if you're buying like a 30-year treasury, the higher the rate is to compensate you for the risk that you're taking, right? And I think for, what people kind of saw previously was an inverse, a rate flip, which historically folks have said that's a recession indicator. And the reason for that is because they say, hey, if rates are higher now, that means that the market is expecting Fed to lower rates to go, so the long-term curve is kind of, shorter, right, lower. So that's a recession indicator. I think we've kind of seen that sort of reversing back. I think in general, right, I'm a big believer that, for example, the dollar will continue to be the dominant sort of currency in the market. I know that there's a lot of talks about de-dollarization, but I think that if you're looking at what's happening in the treasury markets, there's a lot of folks still buying in the options. And I think that that's going to help sort of maintain at least the liquidity and sort of help keep the market functioning. I think that, in the long term, really it's, when you're looking at the 30-year, it's very, I would say it's a lot more resistant to political forces than I think people think, because when folks are sort of looking at buying that, right, it's essentially a bet on America in the long term. And so I think as long as the liquidity kind of stays, I think the yield curve will function the way it's supposed to, which means duration risk, right? The shorter debt you're taking, the lower the rates. The longer you're taking, the higher the rates. And that, I think, is a functioning, healthy market in debt.
You guys want to take it?
So I'm going to answer this question a little differently. The first point is you don't want to over-leverage your investment. You've got to be very, very careful on the leverage that you're taking. The second thing I would say is when you're making the investment is you've got to do a sensitivity analysis to model if the interest rates go up, if they go down, what happens, or if cap rates go down. Cap rates are very, very sensitive to interest rates. The third thing I would say is, with interest rates coming down, there's a significant psychological impact to people realizing that this will help the economy, it will help companies' borrowing costs, it'll help the sector. The number that we tend to focus on is the 10-year Treasury, which is what dictates what borrowing costs are going to be. And our view is that over the next 18 months, that number comes down. They've started with a 25 basis point cut. We think there's at least one more 25 basis or two 25 basis points cuts this year. And then it depends on who you listen to next year, whether there are 3 or 4 cuts. We think the rate settles at somewhere in the threes. Those that modeled, like I said earlier, that modeled on close to 0% interest rates, those people are going to be have been in trouble and will continue to be in trouble. So look at the 10-year Treasury, make sure you don't over-leverage, do a sensitivity analysis. And I think that the interest rates coming down is going to continue to juice the economy over the next 12 to 18 months. Unless there's a golden swan event like we've seen in the past.
Yeah, I would agree that we're going to end up in the threes on the 10-year. The way that we structure our financing is we generally do Fannie Mae or Freddie Mac fixed rate financing. We don't want to ever worry about our rates up or down, and is that going to affect our mortgage payment? We like to have it just stable. You still do a sensitivity analysis based on various costs that you can't control, such as insurance and real estate taxes and projections on rent growth. But we definitely prefer just fixed rate, 7 to 10-year loans. Again, nice, boring, steady, sort of an investment in a box. And when the time comes for when we want to exit the transaction, then that'll gives us a several-year window to be able to gauge when we should exit that transaction and not be in a situation where we're forced to exit a transaction.
Okay.
Or an investment. Yep.
I do have another question to add on, but I'll come back to that if we have time. Is there any, you guys have all touched on some advice for the audience. Is there any other advice you'd want to give, just in terms of, that's very personal to you, in terms of how you think about real estate or things that they should be thinking about?
Yeah, I would say my piece of advice is have a thesis, have something that you believe in, and know clearly what you're investing in, right? So from our standpoint, we deploy 2 different strategies. So first strategy, number 1, we understand that there's a risk component to it. We also understand what the returns need to be, and we are pretty clear with investors that, if you're buying land, you're not generating cash. There needs to be work that needs to be done in order to turn it into something. There's risks around zoning, infrastructure, these types of things. But the way we underwrite is you need to be compensated for that, right? And that's a different sort of investor profile versus in our land banking side, the investor profile is more like retirees. It's more folks that are looking at alternatives to high yield savings accounts where they're getting a monthly payout with higher yield. And for them, we say, look, like if this is your goal is to go generate income, fixed income, right? And we've also had a lot of folks talk about operational risk, right? With insurance and taxes and all that thing. For us, this sort of business line, you sort of offset all that. You're putting that onto the counterparty, the home builder. So the type of investor that's investing in this sort of strategy is very different than the type of investor that's investing in this sort of strategy. And the return profiles are different as well. So I would say, my piece of advice is know what your goal is with your dollar. I would say also diversification is important. I think a lot of folks in the real estate space, they sort of do a disservice to the community when they say never invest in stocks. I would say think of it as a portion of your portfolio, right? This asset class is a portion of your portfolio. Know what you want to utilize it for. And also, just do due diligence on the operator, right? I would say history is really important. How much money have they paid out? How many things have they exited? What's their business plan? Because that's what you're really making a bet on, right? Is you're making a bet on, will they be able to execute their business plan?
So I will add on to that is Indians love real estate. And I think it's important that you look at it from a more global perspective, where real estate fits in your asset allocation. You have stocks, you have bonds, and then you have alternatives. And within alternatives, you have real estate as one of them. You have private equity, venture, all of those things. Then within real estate, you have different asset classes, and they have different return parameters. It's how long you want to hold it. What are your return expectations? One. And most importantly, it's after-tax returns that are important for you to consider in real estate. Real estate is good because you get the depreciation flow through, which makes it very, very positive from that perspective. The second thing is, we are in the relationship-based business. Your reputation always precedes you. Invest with people you know and trust, and also ensure how much skin they've got in the game, to ensure how much of their own capital are they putting at risk, rather than management fee offsets, which is taking a discount on the management fees. You want to know how much actual cash they've put in it. Third is the experience with the team through multiple capital cycles, because the markets, real estate is very cyclical. Every 7 to 8 years, there's a trough, and then there's a peak. And you just want to make sure that they've been through those multiple cycles to be able to handle those downturns, which will happen. And the next one is ensure that they've got a plan for what happens when things go wrong, because things will go wrong. And how you recover from that is more important, and how they handle that is more important.
You guys covered it all. The only thing I'm going to quickly add is real estate, doing real estate like the way that we do it, it's very much, I call it a team sport. You need to know a lot of people. There's a lot of professionals involved. You need to know investors. And so it's very much you're running a business. But that's all excellent advice by my co-panelists.
Can I add one more thing? So
No.
I would say DPI. That's really one of those metrics that's the most important. How much cash have they generated? Because that shows how much value they generated. That I think is something that every alternative investor should be asking to every alternative investment they have. That's the most important thing, right? How that really shows you their performance, their ability, their cyclicality, right? It's DPI.
Great, thank you all. So I think we have time for questions. Is that what you all want to do? Questions from the audience?
Thank you. I'm just curious to understand where the panel think we are in this cycle. In my simplistic mind, last round cycle was maybe we started to take off in 2012, starting in like 2001, kind of thing. 2006 was the peak. 2008, 9, 10 was the crash and a lull. And then 2012 is when we took off. For each of your areas, where are we?
Stephen, do you want to go first?
Sure. So I learned a long time ago that it's very, very difficult to invest in real estate thinking that you're going to invest, at the low point and sell at the high point and like a stock. When you're making the type of investments that we're making, you're going to be holding it for 5 to 10 years. In fact, the type of debt that Fannie Mae and Freddie Mac give us really warrants that because of prepayment penalties, because our debt gets converted into a bond and there's something called defeasance, and it's super complicated, but it's all meant to have you hold it for a long period of time. With that said, if you believe interest rates are going to come down, then it's a great time to buy now, because that's going to create value for you just simply through a market dynamic. And so I think that's a good thing. I think it was probably higher risk when everything was at zero and you knew rates were going to go up because they couldn't go anywhere else. But now that they're up, they're probably going to be coming down, and that's a good thing in the cycle.
Anybody else got a comment on that?
Yeah, I do have a comment. So you got to look at the real estate. If it's good real estate, it doesn't matter whether you're at the bottom of the cycle or the top of the cycle, as long as it's good real estate. That's the most important thing. Interest rates affects valuations. if you're looking to hold it for the long term, with interest rates coming down, valuations are going to go up. And the fundamental thing is ensuring that where it fits in your portfolio, what the asset type is, what your hold period is, what your return expectation is, and how good the real estate is before you invest in it.
Yeah, that's real quick. There's, for those that like Warren Buffett and his former late partner said, I'd rather get a good deal on a great asset than a great deal on a good asset. And I would certainly agree. I'd rather buy a high quality piece of real estate that you know is going to be in a great location for a long period of time.
Okay. Next question.
Yeah, it's me. This question is for Sandeep, Suraj Reddy. The question is, a lot of people have bought lands in Austin in 2023, 2024 at a very big fortune. And now, unfortunately, it's down by 30 to 40% at least. And everyone is fearing that they might further go down. So what's the solution for these people who have bought at such a high price and they've been all down? What is the...
That's you.
Yeah, so interestingly enough, this goes back to my concept too, that cycles are also local. So in Austin, I would say, long story short, a lot of those folks that bought in Austin didn't know what they were buying. They bought property that had no utility access, that was way out in the burbs, right? That they were closing on those deals in, they call it a 30-30. So it's a 30-day feasibility, 30-day close, and they were buying it for way too much money. And it's actually really funny for us, we looked at that as an opportunity. So for us in the last year, we've done some land acquisitions from those type of sellers because there's no liquidity in the market. And from our standpoint, when I look at land, it's only as valuable as the end product, right? So for us, when we're looking at ranch land, it's really what can you sell a house for and how many houses can you put on there? And then you've got other concepts like financing districts, right, that you can put on there to make more cash flow. But for us, it's really, how do I get my utilities? How do I get my, water lines? How much does that cost, right? How much do the roads cost? How much does the topography change? How much does that cost? So I would say a lot of the folks that bought that are down that much, they bought really with speculation. And honestly, I think this past 2 years has been healthy for the market because your speculators have kind of tranched out of the market. They've gone out. And now you've got more folks that are really focused in on the fundamentals. And one other thing with Austin, I would say in general, is Austin was actually 6 months ahead of the cyclicality, right? So because it was the poster child of the pandemic and then the poster child of the fall, but you're actually seeing in the apartment market massive absorption rates. You're actually seeing home prices clip up, which I think now in the rest of the country, you're kind of seeing it falling. Like we also invest in Florida, and in Florida, it was really doing really well when Austin wasn't doing well. And now Florida's not, Florida's a different market. It's not doing as well, but Austin is kind of climbing back up. So I think it's really just, it really is about what asset are you buying, and it's very local. Even in the Austin market, there's submarkets, it's all very local.
Going back to the question a little bit, though, if you were an investor in one of those properties, I would assume really, the first thing you're going to look at, what's the debt situation? And, is there something impending with the debt that's eliminated the value of your equity? If not, the question then becomes, how long can you carry that investment, and what is the cost of carrying it between interest, if you have to pay interest, and real estate taxes? Because eventually, if you could hold it long enough, right, the value should come back. At some point, it may take 10 years. I just don't, you don't know what the situation is, but.
Yeah, totally. And I think in land, right, what you're seeing is land prices in Texas have not gone down, at least what's transacted, because a lot of people bought it with cash. Way less leverage. Banks just would not give a ton of leverage on land in general. So most people that hold assets, it was like 100% cash that they're sitting on. I would say my sort of recommendation is, number one, ask the sponsor what their business plan is, right? And sort of how do they plan on executing. So I think the really good thing I'm sure it's everywhere, but at least, I know Texas, but in the counties and cities, you have a lot of options that you can explore for entitlements to fix your issues. So for example, for us, we do a lot of on-site treatment plants for areas that don't have wastewater. And for water, we secure rights from private holders, private water holders, and drill for wells, right? We're doing that on projects. We're also creating these things called MUDs, municipal utility districts, that help you offset a ton of that infrastructure cost. So I would say there are options out there, depending on the jurisdiction and where you are. It's just you have to be proactive, because if your business plan doesn't work as intended, you got to go pivot. But I would say, yeah, a lot of those folks, they are probably going to sit on that dirt, and it will be valuable, right? It just depends on when does the value come back and when does it come back to the level they want to exit at.
I think we have time for one more question. Is that right?
Hi, Stephen told me no hard questions, so I'll take him up on that. I do have two questions. When you look at raising funds, is it easier or harder now than it was? I'm seeing it being harder, especially for larger projects. Investors are a lot more cautious. And second, one of the questions that one of the online commentators always asks at the end, what are we not talking about that we should?
I'm going to go first just on the sort of the capital side of things. It's as I said earlier at the beginning of the panel, it's really hard to capitalize any deal for a number of factors. One, the economics are very challenging for any sort of new construction to have the numbers to work. And then capital is very selective. Folks raising funds, whether it's commingled funds or individual project funds, it's a very challenging market for that. There's been, the stock market's still pretty high. The real estate market has struggled, so that always impacts institutional allocations of capital because it's formulaic. So the amount that they have available to real estate may change. They're also very selective on strategies and asset types that they'll look at. So, bottom line from my perspective is it's been as challenging as it's ever been to capitalize real estate projects in my 30-something year career.
So I'm going to answer that question two different ways. When you say raising funds, if you're raising an institutional fund, it's very difficult right now. In our case, we raised two funds, and we have decided not to raise the third fund, not because of the difficulty, which is also under consideration, but because the capital, there's no liquidity in the markets, so it's delayed the exits of our fund investments. And so we felt that it's not fair to go back to our investors and try and raise Fund 3 without returning capital to them. On an individual program level, on a deal level, and a syndicated level, it is difficult, but it's not as difficult as raising funds, as raising an institutional fund at this time.
So on your question related to what we're not talking about, it's really the impact that insurance and real estate taxes are having on the operations of properties. That is really it's impacting all operators. We certainly go through appeals on real estate taxes, but we're seeing jurisdictions, and fortunately Loudoun County has been very good. It's a pretty steady rate, but some other markets, they are very aggressive on raising real estate taxes. And we've seen some transactions where, we project it, but it's still going up 10, 20%, which is a big number. And then on insurance, it's the same thing. You do your very best to be able to get the lowest rate by keeping a high quality property, but you could have something like a massive hurricane in Florida that causes rates on your property in Roanoke to go up, right? Even though nothing happened there. So, and it seems like insurance rates don't come down. And real estate taxes don't come down. So those are two really big things. And so I would say to add to that is when the public officials, not Henry, but the other elected public officials that say we need more affordable housing. Well, they just have to look at themselves and stop raising real estate taxes, start doing things to help get insurance down, and that will help create a lot more affordable housing and more tenants.
Real quick.
Yeah. I just want to, the other point I want to make to emphasize how local politics impacts real estate. We invested in 4 workforce housing projects, 3 in Atlanta, 1 in Louisville, Kentucky. We sold 3 of them for a very good return. The 4th one got stuck because of COVID. The local jurisdiction said that to evict, you've got to use your local sheriffs, which took 9 months to evict somebody. The tenants figured this out and said they're not going to pay rent for 9 months. somebody's going to bear that cost. And then once it's time to evict them, they come back to you and say, give me $5,000, I won't trash your apartment and don't touch my credit report. So those local jurisdiction laws can significantly impact. And now when we invest, we are very sensitive to the county, and not to politicize this, but whether it's red or blue, because that impacts it, unfortunately.
100%. Yeah, that's a great point.
Yeah. All right, well, how about a round of applause for this esteemed panel? Thank you, guys. Appreciate you all having us. Have a great conference.
Thank you.
Thank you.
Thank you so much to our amazing speakers for that insightful and engaging chat. Now I would like to call upon the ATA Business Committee members, Naveen Ranga, Srikant Nadriga, Zeenat Kundur, and Ravi Chella, to felicitate our speakers and moderator as a token of our appreciation.
Thank you so much. Thank you so much.
A quick group picture, please.
Thank you so much.
Hello. I would request everyone to give them a big applause, because these are the things which we don't just get like that. They have been in the industry from almost 20 to 30 years. And thanks to them for sharing their real-time experiences. It's not so easy for us to share a 20-year business secret on the stage like this. But thank you all for asking the questions too. Thank you very much. Bye-bye.